Okay. Actually, I see that camera is a bit weird. Okay, so what we're going to do now is that we're going to talk about asset liability management, which in a sense is a slightly more direct, application of the concept that we will see. So hopefully, what I'm going to try to convince you is that this concept of duration that we define in different ways, and like we took derivatives and so on, it can be useful to think about very simple questions of asset liability management. Right? So I'm going to start with one motivating example, and I think for today we're going to see like one way to do asset liability management, which is very simple and not very interesting. And then next time we're going to talk about what is called immunization, which is where we make use of this concept of duration. So the example I want to start with, so if you want, you're going to see that it's really like two sides of the same coin. So the previous set of slides, I introduced it with banks. So what are the problems that banks face? Here I'm starting with one other type of financial institution that we already talked about, which is pension funds. And the idea is that there's a huge, problems for pension funds in the US in particular, but that's also the case in Europe. We're going to see that actually these problems can be related to the concept of duration that we talked about. That we can think about them in terms of duration. So what are pension funds? I guess, well, you all know that these are institutions that manage assets on behalf of employees, right? So you're employed, typically you make contribution in the pension fund, and then you're going to get payouts when you retire. Right? What's important is that there are traditionally two types of pension funds. One is defined benefit, the other is defined contribution. Right? The defined benefit is really something where you get promised a certain amount, right? So for example, if you have a retirement plan with a company, it could tell you, well, you're going to get 80% or 70% of your last salary, right? So that could be one example of a defined benefit, which means that there's really a payout that the pension fund is telling you you're going to get this, right? And that's a fixed amount, right? So that's why it's defined benefit, because what's actually the variable, if you want, is the benefit that you're going to get, not what you put. Another type of scheme is called defined contribution, right? And in this one, if you want, you put some money, right? And how much you earn, well, it's just going to be what the pension fund invested, right? So here, if you want, you can think about the return is, what the market can deliver. Right? It's just like, you trust you trust your money for your pension, you put it in a fund. This fund can invest in many different things. It can be equity, can be bonds, can be even more exotic things. And whatever this pension fund generates, that's what you're going to get, right? So in that case, if the market goes up, you're going to get more. If the market goes down, you're going to get less, right? So that's the main difference. If it's defined benefit, I tell you that I'm going to pay you, $80,000 a year when you retire. This is what I have to pay. Right? No matter whether the market goes up or down, I cannot, as a pension fund, then go and tell you, yeah, look, I thought the market would go up, it didn't, so now I want to pay you less. Right? The benefit is defined. The defined contribution, again, what you get is, if it's a bit the same as if you were investing directly in the market, you get what the market can deliver. Now, in particular, for the first kind, so this defined benefit here, there are severe concerns that they're actually underfunded. Right? Which simply means that they don't have enough assets to match their liabilities. So the variable that people look at typically is the funding status of a pension fund, right? This thing here. How do you define the funding status? Well, it's pretty easy, right? So, what does it mean to manage your liability with your assets? You should have enough assets to cover your liabilities, right? So there's nothing very fancy here. So what you do is that, you look at the market value of assets and you subtract some kind of value of your liabilities, right? So the market value of assets, that's pretty unambiguous. You just look at what are the assets on the balance sheet of the pension funds. And if it's equity, well, you just have the price, right? As long as you have a price for this, the market value of assets is very easy to determine. Of course, if pension fund invest in like more exotic assets such as private equity, real estate, infrastructure, it's maybe harder to get a market price. But the idea is that you will try to price all the assets of the pension fund. Now, as we will see, the much more controversial part is this one, right? So the idea, is that you can view the pension fund as having between today and forever some kind of stream of liabilities, right? So these are liabilities that the pension fund has to pay. And basically, you want to say, well, the market value of assets is the value of assets today. I'm going to have to make payments in the future, but of course, I want to compare them, so I have to discount my liabilities back to today, right? So that's not very surprising. And what you're going to do is that you're going to take discounted value of your liabilities. Right, so here I'm taking a constant discount rate across maturities, but you don't have to do that. Okay. Now, what you see here is that which discount rate you choose is going to be very important for your funding status, right? And it's not hard to realize. If I discount my liabilities at a higher rate, well, this will deflate my liability side and would make my assets look better compared to my liabilities, right? So I'm going to increase my funding status, right? If I choose a higher R, my funding status better. Right? So what we're going to see is that there's actually an important controversy about what kind of interest rate the pension fund should use in order to discount their liabilities, right? So let's suppose that we do it with a given interest rate, right? So this is a picture that I took from an article of the FT, I think 1 or 2 years ago, where you see this funding status not for all pension funds, but for some pension plans that are sponsored by S&P 500 companies, right? So whatever number you see here is not the total amount of funding or underfunding; it's just for these companies. Okay. Now what you see here is that it's in billion, and you see that this number is fairly negative. And I can tell you that it didn't really improve in the last 2 years, right? So if anything, the number today would be worse for these companies. Now, I said there's a lot of controversy about what kind of discount rate you should use. Here, they use the investment grade bond yield, right? So relatively safe corporate bonds, not yet, government bonds, but these are not like huge rates. So first, what is the first pattern you see? So, between 2007 and 2012, this funding status, so these pension funds went from being just funded, so market value of assets equal to present value of liabilities, to severely underfunded. Okay. So what happened during this time, right? So if you think about, the variables that enter this funding status computation, you have the market value of assets, you have the value of liabilities, and you have the discount rate that you use, right? So knowing what we know about the recent history of interest rates in the US, but also in Europe, why would it make sense that the funding status of these pension funds deteriorated so much? Yes, please go ahead.
Due to the low interest rates.
Yes, exactly. If you remember the yield curve that I showed you, what happened in 2007? Well, there was the financial crisis, right? So here there was a financial crisis. Now, of course, you might say, well, there was financial crisis, so the value of assets also went down, right? Which is totally possible. But really, the big development that happened in the interest rate market is that the interest rates went down, right? So okay, so that was the big development after the financial crisis, and we know that interest rates have been staying low since 2008. So of course, interest rate went down, you discount your liability at a lower rate. We know that the present value of that liabilities are going to be bigger, right? So if you go back to this thing, what it means is that this component, this component here, that will increase, right? So your funding status will look worse. Okay. That's the first fact, and in a sense, everybody agrees about this fact, right? So everybody, we discuss this pension fund will say, yes, there's a problem of underfunding of pension funds, and this might be related to the low level of interest rates. Right? Now, what's interesting is that, there's actually a big controversy about the size of this deficit, about the size of this underfunding status. right? And it's quite something that is quite interesting about US accounting rules in particular, which kind of tells you that there's maybe something wrong about different numbers that you get. So what is that? So the US accounting rules allow the funds to use this expected return on asset to discount their liabilities, right? So your pension fund, you say, well, you know, I'm expecting to get 7.5% or 8% on my assets. That's the rate I'm going to use to discount my liabilities, right? In a sense, you know, if you think about this formula here, you know, this, you know, assuming a higher return on your assets means that, you know, this thing, I'm going to do it like this. Kind of makes sense because, you know, assuming that you discount your liabilities at a higher rate is the same thing as saying I'm going to get a higher return on my assets, right? Today, my assets are worth 1 billion. I'm going to get a return of 8% on these assets. So, you know, it kind of makes sense that I discount my liabilities at 8%, right? So let's say the logic of it can kind of make sense. Now, what are the potential issues with this, right? So this number that I took is from a study by Joshua Rowe that looked at different pension funds in the US, and he found that, you know, the discount rate that they used was on average 7.36% in 2015. There's been a recent survey by other researchers from Stanford that show that, you know, these numbers have not really been updated since 2015. Okay. So what's problematic about this number? And there are different ways to see that question. Let's say that if a pension fund comes and says, you know, look, we're expecting to earn 7.5% on our assets. So with this number, we discount our liabilities and we're not so severely underfunded, right? So what's the issue with this? Yes, Coach?
I'm not sure, but you shouldn't discount liabilities at that rate because the liabilities, or I mean, they will happen anyways, right? The discount rate is too high for the riskiness of the cash flow. Yeah,
that's a very good point. So there are actually two, you know, things that you can say. First, you know, even if you forget about that, which is, you know, the smarter version of the point, is just to say, well, where are you going to get 7.5% these days, right? So pension funds, their bread and butter, you know, is fixed income, or at least used to be fixed income, right? Treasuries, maybe, you know, like investment grade corporate bond yield, but, you know, traditionally, they invest in fixed income, right? So that's the thing. Okay, so the question is, you know, where are you going to get this 7.5%, right? Now, as we actually what we saw in the recent years, and we're going to come back to that, is pension funds move to riskier asset classes, right? So they used to own stocks and bonds. Now they're moving into private equity. They're moving into, as I said, real estate infrastructure, asset classes where they think they can get a higher yield. The second thing that is kind of wrong about this is that, you know, they can use their stated expected return on assets. So you can go out there and say, you know, oh, well, I expect to earn 10%, and oops, your funding status just goes down, right? Because you discount your liabilities at a higher rate. There's not a lot of scrutiny around this, you know, stated expected returns on assets. So that's the second point. And the third point, which is more important, and that's what we said, is that, you know, if you go into riskier asset class and you can maybe earn, you know, 7.5% on average, right? This is possible. You know, suppose you put a lot on private equity, on expectation, you might get this high return. But the question is that there's also a lot of states of the world where you're not going to get it, right? Because it's risky by definition. The problem is that, you know, if you define benefit pension plan, you have to meet these liabilities, right? This is a fixed liability that you have to meet in the future. You cannot tell people who invested in your fund, look, you know, I tried my best, but, you know, I didn't get that return, right? It's really different if you define contribution, say, you know, look, this is what I invest in, and this is the return you're going to get. It can be high or low, but, you know, nobody can complain. If you define benefits, you promise a certain payout, and it's not like you can say, well, the asset classes didn't pay off, so I'm not going to be able to deliver the return, right? So the main issue is that liabilities are fixed, right? So they are set in advance. You promise a certain payout to people who invest in your pension fund. Okay. And so what's interesting is that this Professor Joshua Rowe from Stanford is actually in quite a fight with these pension funds and the government for a couple of years about this. He says no, what you should use is you should use a discount rate of instruments that can guarantee you a safe return, right? That's what's relevant because you're going to get the money that you need to meet these payments. So suppose you do that and you discount your liabilities at using the Treasury yield curve. Now, for all, in particular, the public pension fund, he estimates that the number that it gets in terms of underfunding is 3 times as large as the number that the government, is producing, right? Because the government number relies on this accounting rule here, where pension funds can use whatever expected return they state on their assets to discount their liabilities, right? Joshua Rowe says, no, you should use the Treasury yield curve. And if you do that, of course, the rate is much lower. So when you discount, you're going to get a much bigger value of your liabilities, hence a much higher level of underfunding. Now, the thing is that this controversy, has important public policy consequences. It's not only, it's about which discount rate should we use. It's kind of an arcane debate, right? The question is about whether these public pension schemes are underfunded or not, right? Now, what is the problem is that, if they're actually as underfunded as what Joshua Rowe says, who's going to foot the bill at the end, right? It's going to be taxpayers, right? You have to meet the deficits in some kind of way. You don't get it from the return on your assets, so taxpayers are going to foot the bill, right? So you can imagine that in terms of the political economy of it, for many state, municipalities, local council, it's pretty tricky, right? In a sense, it's either you say to all people, well, we're not going to be able to pay this defined benefit plan that we had in mind, or you say to to young people, well, you're going to have to foot the bill because we're not going to be able to pay these retirement schemes, so we're going to have to tax more. Right. And relatively speaking, who's going to pay the burden of this higher taxation is more the young households, right? The old households are going to pay a bit the bill, but they're also going to get the benefit of having this higher payments, right? So it's quite a big debate.
Well,
yes.
How do the pension funds motivate to use that discount rate, or how does the government do it? Because it isn't just finance 101 to match the riskiness of cash flow with the discount rate.
Yeah, no, exactly. I mean, I totally agree with you on that. Actually, we had at the Swedish House of Finance a presentation on that very topic on Friday from someone also from Stanford, not this person, with great data about pension funds, and she showed us, these reported expected returns, and it was still, in this ballpark of 7.5%. And when we ask her, say, that's the regulation, that's the way it works, that's just accounting rules, right? So I agree with you. It doesn't make a lot of sense to me. And that's why this Professor Joshua Rowe, has been fighting for years with government agencies to make them recognize that, there's a problem with that. But my take is that, everybody that has done some finance would understand that. But, again, the political economy consequences of this could be pretty severe, right? So, I don't know if that's the definite answer, but that's at least part of the answer. Yes, please.
I think the Swedish pension system, when they actually, it's called AP funds, Allmänna pensionsfonder, that they mostly invest in equities, and it's equities with, they also have some sort of leverage. I think on average it's 120%.
Yep.
Wouldn't 7.5% be somewhat okay then?
So you're right, but there's one thing that is very important. It depends if you're, defined benefit or defined contribution, right? If it's just, people like you and me putting their money, and if you want, what's the contract? If the contract is, you invest your money with us, we like some kind of leverage fund investing mostly in equity. Yeah, we all know that, we might get this 7.5% expectation, but we also know that, if things go wrong, we're not going to get it. And nobody's going to complain, right? We know it's an average thing. It's an average statement. So if it's defined contribution, that's perfectly fine. I totally agree with you on that. But if it's defined benefit, it's like you and this AP fund signing contract saying, no, you have to pay me, let's say 80% of my final salary, no matter what, right? So that's the difference, you see, because maybe on expectation, the AP fund is going to be able to do it, but maybe not, right? So in this case where it's a defined contribution, that's fine. There's no problem. But it's when it's defined benefit that you have these hard liabilities that creates a problem.
So, if I'm understanding you correctly, we don't have these predefined benefits in Sweden.
Most of it is not defined benefit, but you do have it in the rest of of Europe. So in Sweden, I don't know how it works with civil servants, but I know that in many countries in Europe you do have a defined benefit for civil servants. So just that would be a pretty big deal. And so, actually, that's one of the things that that is happening here is that in the US, many US companies, they ended this, final salary pension schemes, right? It's, really defined benefit. I'm going to give you this no matter what happens to the market, right? So that's one of the consequences. And in Europe, you also see, like a shift from, defined benefit to defined contribution. So you could say that, as on many things, Sweden is ahead of the curve because they kind of know that, well, it'd be better to do defined contribution on this account. But there's a tendency to move toward that system. Yeah. So what are the causes of this, right? So that's kind of the big picture thing. And then the next slide, we're going to come back to our concept of duration. But I think that's just important to know. Of course, if you have a defined benefit pension scheme that says, I'm going to pay you 80% of your final salary as long as you live after retirement, and you don't adjust enough the age of retirement, well, increase in life expectancy are going to cause problems, right? You just increase the liabilities that you have to face. So that's one cause. We already talked about this one. There have been really low yields since the financial crisis. So you can view that in two ways. Either it means that it's going to be very hard to get a high return on your assets if you invest in fixed income, right? That's the asset side of it. The liability side of it, which is equivalent, is to say, well, now you discount your liabilities at a much higher rate, right? That's what I'm saying. And some people have said that, in 2019, when this article was written, there were very high stock valuations already. So any gross return that you can expect from stock was already, in the price and was not to be expected in the future, right? So even in stocks, maybe it was kind of hard to make this kind of return. But of course, this was before the COVID, and we know that with the COVID and central bank interventions, the stock market was a bit messed up. So what can you do, for pension funds? Well, there are kind of three ways. So there's the ex-ante smart strategy, which is this one. It's called liability-driven investment. In a sense, I find it a bit weird because you should always do liability-driven investment if you're an institution that has liabilities. Because what they mean by that is that they need to have strategies that hedge against falling rates, right? So if you did that in 2007, yeah, that's great for you, right? Because interest rate effectively fall, which means that you could get an edge, right? But many pension funds didn't do that. Now, what about now? Interest rates are already low, so it's not about hedging against falling rates, right? As I said, we have witnessed a move into other asset classes, more illiquid, more high yield, real estate, private equity, and this has increased substantially over the past 10 years. Right? So, if you're interested in private equity, there's a lot of discussion about there being a lot of money to be invested for private equity. They have a lot of dry powder. They can raise a lot of money for their funds. Some people think that part of it is supply side, where there's a lot of institutions such as pension funds that have a lot of money where they want to earn a high return, maybe because they're underfunded, and so they will go to these private equity asset classes. Yes.
Moving into these illiquid asset classes now with the already low interest rates, won't that also pose yet another risk, because those valuations now are based on the low yield environment? So once the yield would rise again, both the asset side would drop, right? And especially looking at real estate, if you do the expected future cash flows,
yeah.
Meanwhile their liabilities would, they would decrease. Exactly.
So yeah,
never mind.
So in a sense, these guys, it's a good question because it's different from banks. Like these guys, they kind of benefit from an increase in rates, right? But yeah, it's good to have in mind. Okay, and what is the last extreme thing that you can do? Well, you can cut your liabilities, right? So that's the last thing. It's a form of default, and there's different ways in which you can do that. So one thing I already said, some US companies stop this, these final salary pension schemes where you kind of guaranteed something. One way to do a soft default is to actually cut pension benefits. We used to say that we're going to pay you 80%. We're actually going to pay you only 70% of your final salary. That has happened in many countries, and I'm not talking about random countries. That they are happening in the Netherlands, for example, and there are other countries that are discussing this thing. Or when all hell breaks loose, there can be hard default, and actually the municipality of Detroit defaulted in 2013, and part of it was this financial burden they had from their pension plan, which was severely underfunded, right? So that was one of the causes why they actually had to default. So quite a serious issue actually. Now, coming back to duration here, What's the connection with what we talked about before, right? Well, one way to see, the problem that pension funds face, and we already just mentioned it, is that what they don't like is when interest rates decrease, right? So remember, that's opposite of banks, right? Banks have long-term assets, short-term liabilities. What they don't like is when interest rate increase because the value of assets go down and the value of liabilities goes up. Right? Now, what about pension fund? Well, this quote, can explain a lot, right? It says that if you have a 1% percentage point fall in long-term rates, that will increase the liability of a typical pension scheme by around 20%, right? But the value of the asset would only go up by about 10%. Right? So what it means that duration of liability is 20. That's exactly the definition that we had before. How much does the value of your liability increase if there's a change in 1% of interest rate? And duration of assets is only 10. Right? So assets, are less sensitive to interest rate than liabilities. Right? So if interest rate decrease, liabilities increase by more than assets. Right, so that's exactly what we discussed just before, and that will be penalizing for these pension funds. Again, remember that typically for banks, it's the opposite pattern where you have duration of assets, duration of liability. Right. So here you see that we kind of relate this problem of pension funds, the fact that why did they suffer so much from low interest rates? Well, because maybe they are not much in terms of interest rate risk. They are trying really hard to do so, right? I mean, they're not stupid. They understand that the liabilities are very long dated and that they should also have long dated assets. But there's only so much you can do. And apparently, at least in the UK, they're clearly not much. There's a big discrepancy between these two. Right, so the kind of takeaway from this and what we said about banks is that many kind of deep problems that we can think about for financial institutions, asset liability management, at least in the fixed income world, can be summarized in terms of sensitivity to interest rate risk, right? Thinking about duration, how sensitive you are to interest rate risk allows us to think about issues that are, as deep as whether public pension funds are underfunded, what is the model of banks, do they take interest rate risk or not, right? So, this is just a bit to tell you that, sometimes these concepts of duration and etc. can seem a bit dry, but actually, if you put them to work, you can think about these interesting issues. And remember also last time we talked about how we can think about rising inequality in terms of duration, right? So quite a lot of mileage that we can get from this concept. Okay, so I'm just going to start with this because I will end 5 minutes early, just as I promised. We're going to talk about asset liability management now a bit more in detail. I'm going to see that there's essentially 2 techniques, which are cash flow matching and immunization. You're going to see that cash flow matching is very simple, right? So that's going to be a warm-up for next time. So what's the starting point? Well, we want to think eventually about pension funds and institutions like this, but just to simplify, we're going to think that we're today date 0, there's date T, and you have to pay some liability L at final date T, right? So you have to cover that liability. That's why it's called asset liability management. So the idea is that you want to invest in an asset that allows you to pay this liability, right? Now, what's the ideal asset to do that? Well, it's not very complicated. You would want to have a 0 coupon bond that has the same maturity as your liability, right? I mean, that's very straightforward, matching asset with liability. You effectively short a 0 coupon bond with that liability, right? So on the long side, you should be long a 0 coupon bond. How many of these bonds should you buy? Let's call that X. Well, again, it's fairly simple. Cash flow matching. You want the cash flow from your bond, right? So M is the face value here to match the value of your liability. Okay, so super simple. You can write that in terms of present value. So you take everything back to date 0, and you end up with the quantity of bonds here is equal to the present value of the liabilities divided by the price, right? Which is just saying that the market value of your investment, X times P, should be equal to the market value of your liability. Now, what's nice about this is that, well, whatever happens to interest rate, you're going to be able to meet your liability, right? Because today you buy this thing tells you, I'm going to pay you M per unit at date T. If you buy X of it, you're exactly going to get L at date T, so you cover your liability for sure, right? So that's, very simple. So in a sense, if you had, 0 coupon bond for all liabilities and all maturities, asset liability management will be fairly simple, right? And this also tells us why, many investors like these 0 coupon bonds, right? And we saw before that the government typically does not issue zero coupon bonds. And that's why you have these banks that take this coupon paying bond, strip out the zero coupon part and issue the zero coupon part to these financial institutions, right? Because they like it so much for asset liability management. Okay. Now, slightly more tricky, suppose that you don't have a zero coupon bond for that maturity, right? So here what we're going to do is that we're going to say, well, let's use a coupon bond, right? Now, we're not completely stupid. We're going to take a coupon bond that matches at the date of the liability, right? So that doesn't change. What changes now is that you get additional cash flows, both the coupon payment at the maturity and also the coupon payment in the meantime, right? The really problematic ones are the coupon payment in the meantime. Okay. What's the idea here? Well, you again want to match your liability with the cash flows of your asset. How are you going to do it? Well, you're going to think about the following things. At the maturity date, I'm going to get per unit M times C, right? That's the face value plus the coupon, just as before, except that before we had zero coupon. What am I going to do with the coupon that I get in the meantime? Well, I want also to use them to match my liability, right? So what I'm going to do with them is that I'm going to reinvest them at whatever interest rate I can get in the meantime, right? So this one that I get at date one, I'm going to reinvest, for example, for 1 year. Then I'm going to take all my coupons that I get here, and I'm going to reinvest them again. I'm going to put all these coupons, reinvest them until date T, right? I want to use them to match my liability. Okay. Now, what's the trick here? Well, as usual, we don't know at which rate we're going to reinvest this coupon, right? So these rates are not known today. Today, you don't know at which rate you're going to be able to invest between year one and year two. Okay. Now, what's the problem here? Well, if today the interest rate is 3%, you might say, well, I'm going to assume that the interest rate will be 3% in the future. But what if the interest rate falls, right? So today, as your one is 3%, but tomorrow it could be that this rate falls to 2%, which means that you're not going to be able to reinvest your coupon at the rate that you expected. So at the end, at date T, you might end up short. Right? Well, if it's liability you really have to match, you cannot end up short. Right? So what people do when they do cash flow matching, they say, well, I'm going to be conservative in terms of the rate that I assume for reinvesting my coupons. Right? So one assumption that you often see, but that's not the only one, is that you assume that you're going to be able to invest your coupons at 0%, right? So what this thing says is that I'm designing a strategy such that even if I can only reinvest my coupons at 0%, I'm going to be able to match my liability, right? I want to be very conservative. I know the interest rate is 3% today, it might stay 3%, but I really want to be able to match this liability. I'm going to be conservative and assume this reinvestment rate of 0%. Of course, these days 0% might not be very conservative, right? 0% is kind of what you get already. So you might want to assume an even lower rate, but the idea is that you will assume a reinvestment rate that is lower than what you can get today. So here you have an example, and we're going to finish with this slide. So I'm going to let you also look at this example, but this is just to illustrate what we said before. So you have a 1 million payment to make in 10 years. Suppose there's a 10 years coupon available. Well, perfect. You don't have to think about it. You buy for 1 million face value of that bond. That just covers your payment. That's it. Nothing very complicated. So suppose that you don't have, this 10 years coupon, and there's no way to build this zero coupon from other bonds in the market. Right? But instead, you have two 10-year coupon bonds available. Right? One that pays 2% and one that pays 5% coupon. Right? My first question to you is, why would you choose the 2% coupon bond over the 5% coupon bond? Okay, just based on what we said before. Yes, go ahead.
Because it's cheaper.
Well, we kind of know by now that by no arbitrage, nothing should be really cheaper, right? But I think, I can see maybe where you get it in the back.
Yeah, you said that we don't know the interest rates which we're gonna reinvest the coupons. So
yeah, so basically you want to minimize the coupon part, right? So the best asset you can get is zero coupon, right? Now, if you have a coupon paying bond, you're worried that you're kind of paying for these cash flows in the middle, right? And you don't know at which rate you're going to reinvest them, and you're going to be quite conservative about it, right? So if you minimize this part where you're making the conservative assumption, you're going to be better off, right? So if anything, you're going to choose this low coupon bonds. Okay, so I'm going to let you walk to the equation. The only thing that is important here is that you can solve for the number of bonds that you buy. That's exactly the equation that you had before. X2 is the quantity here, multiplied by the face value plus the values of the reinvested coupons. For 10 years, you got a coupon of 2, right? Here you get 100 plus 2. And you assume that your invested coupons at 0%. So at the end, 2 times 10 is equal to 20. That's why you get this number. Now, what's interesting to see is, what's the difference now between the present value of assets and the present value of liabilities. When we had the 0 coupon bond, we saw that this difference was equal to 0. So let me just, here, present value of assets is equal to present value of liabilities. And what you're going to find is that if you do that with a coupon paying bond, you're always going to find that the present value of the asset is higher than the present value of the liability. Whereas in tuition, you kind of overinvest, right? You overinvest because you really want to be sure to match your liability. That's why you're assuming a lower investment rate. And in the end, you're going to need assets that are worth more than your liabilities, right? So you kind of have overfunding to make sure that even if interest rate decrease quite a lot, you're going to be able to match this liability. Yes?
I was just wondering why the coupons are just 20, because if it's 2% of 1,000 and they get a coupon each year,
yeah,
then shouldn't it be 10 times 20?
Okay, so here basically I'm normalizing, like 1 unit of bond is something that pays 100 at face value,
I
right?
see. Okay.
So 1 million is the total thing, right?
Okay.
Yeah, but that's a good point. So, any more questions? This okay. If not, we're going to leave it to this, and next time we're going to finish fully with this lecture. Thank you very much.